Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 328 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to talk about stocks, and not just stocks in the way that we would usually talk about them, but I want to break down the different types of stocks, right? If for no other reason than to teach you a little bit of a lesson about diversification, but also to make it very clear that different types of stocks do different things. There are differing categories, and not all stock is created equal, right? And I want us to be very well versed in the possible investment options that we have. You know that. So I'm going to do my best to articulate to you today the types of stocks that there are, exactly how those different shares of stock work, and exactly how you can make money off of each kind. And hopefully this can be a good discussion for you and help you to learn a little bit more about the investing world. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long-form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, because that's what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Nowadays, when people think about shares of stock, they just think about making money. They're like, hey, I know that I'm, buying this, thing, this security, and hopefully it goes up in value. But how often do we really sit back and think, what is a share of stock? And then ultimately, what are the different kinds of shares of stock, and how can I benefit from these different kinds, and what makes those kinds distinct, and all the different things, right? And so I want to give that a breakdown. So most commonly, the thing that we are going to invest in is what is known as common stock, right? And all this is a piece of ownership in a company, right? If there's this big pie that is a company, and they're selling off pieces of it in order to raise money, if you own common stock, you own a piece of the pie that they actually sold off, right? So the shareholders have the right to receive a proportional share value of any remaining assets or anything like that if the company is to get dissolved. Now, very often when a company gets dissolved, common shareholders don't really get anything, right? Now, it gives shareholders theoretically unlimited upside potential, but you also have to risk losing everything that you invest. Now, common stockholders have what's called limited liability, right? And limited liability, we may hear about this in different parts of our lives, but limited liability basically just means this: you can only lose what you put in, right? You can only lose what you invested. You are not on the hook as an investor for any of the firm's debts, right? You are only on the hook for what you actually invested in that particular company. Okay, so common shareholders, they take risk, yet there is quite a bit of upside because the stock moves based on performance. Now, there's also what's called preferred stock. Now, preferred stock, it works differently than common stock. Okay, it gives shareholders a preference over common stock if the company gets dissolved. If the company goes into bankruptcy, preferred shareholders are going to get paid first. Okay, but preferred shareholders, they have the right to receive dividend payments before common stock holders do as well, because most of what preferred shareholders get paid is in dividends. They don't have a big change in price over time like common shareholders do. The result is that preferred stock as an investment more often closely resembles the fixed income bond investments than a regular common stock. They typically call this a hybrid investment, right? It looks like a bond and it looks like a stock. And it looks like a bond because the price is not heavily tied to performance. Preferred shareholders typically care far more about just getting paid their dividend like a bondholder would its interest payment, but it still has equity preference over the common shares, right? It has this preference over the common shareholders. It is paying a dividend, right? And this dividend can be changed. So ultimately, preferred shareholders, they're just different than common shareholders. Most of what we're going to be talking about from here on out is common shareholders, is common stock that is changing in value based on the performance of the underlying company and not just based on some perpetual dividend that's getting paid by the company in its preferred stock, okay? So then what other types of stock are there, right? So we talk about common, we talk about preferred, right? Those are two big categories, but we're going to really stick to common. What types of common stock are there out there? Well, first, I think we need to talk about the size groups of stocks, right? What do I mean? Well, you hear it all the time. Large cap, small cap, mid cap. What's this mean, right? What does it mean for something to be large cap or mid cap or small cap? Well, stocks get categorized by the total worth of all their shares, which is called a market capitalization, right? Market capitalization for a stock is just the price of the stock per share times the number of shares outstanding. Companies with the biggest market capitalizations are typically called large cap stocks, with mid cap and small cap stocks representing successively smaller companies. Right? There's no precise line that separates these categories from one another. However, one often used rule is that stocks with market capitalizations of 10 billion or more are treated as large cap, with stocks having market capitalizations between 2 and 10 billion qualifying as mid cap, and stocks below 2 billion getting treated as small cap stocks. Okay, large cap stocks are generally considered safer and more conservative as investments, while mid and small cap stocks have greater capacity for future growth but are riskier. However, just because two companies fall into the same category here does not mean that they have anything else in common as investments or that they'll perform in similar ways in the future. So I'll give you an example there, right? Tesla is a large cap stock, right? It just broke the $1 trillion mark last week for the first time, right? So if you're looking at Tesla as a company, it's at like $1.16 trillion as far as a market cap goes. So it is definitely large, right? Some may even call it mega cap at this point, but it is a large cap company, and it's in the S&P 500, which is a large cap index, okay? But within the S&P 500 is also a company like McDonald's or a company like Coca-Cola, right? Those companies are very, very different in form than is a Tesla. Not only their speed of growth, but also what they do and how they operate as a business, how long they've been around. Everything is just very, very different. And the fact that these are both within the same index does provide you some diversification because they are different types of companies, but ultimately they are both large companies. One just has more upside potential as far as growth, more volatility of the stock than the other two do. Okay, but they are both large caps, okay? So the reason that this is important is because we want to be buying, if we are trying to be diversified, we want to buy stocks in all of these different areas, all of these different sizes, because if you don't diversify over size, then ultimately you can end up with, let's say, a bunch of stocks that really move really closely together. You have a lot of correlation in the stocks that you hold, and they can end up driving you one way or another, upwards or downwards as far as returns go. But ultimately, we can take a little more risk with mid and small cap stocks and expect higher returns, all else equal, over time. So those can be ways that we can enhance returns very easily, even if we have diversified portfolios of common stocks, okay? So size, that is a way that we can categorize stocks. Now, what about where the stocks reside, where the companies themselves reside, right? Because there are, in fact, domestic stocks and international stocks. And I think far too often, we just focus on the domestic. We focus on U.S. companies. And I tell you guys all the time, I invest heavily in the S&P 500 index, and that is just United States companies. That's just U.S. firms. And so if that's all that I hold, then I have no exposure elsewhere. Any type of shock to the system of the U.S. economy is going to negatively affect those companies far more than it would something that has more of an international basis to it, right? So owning international stocks is a good way to diversify out of just your domestic holdings. Now, it's very difficult in the U.S. to say that, hey, I'm going to put a significant allocation into international stocks, specifically because, one, we have this home bias, this bias that says that, us in the U.S., we're better, right? We have better opportunities than anybody else. Why would we invest anywhere else? But quite literally, the returns of our stock market have pretty much killed international indexes over time. So the question is, why would I put any allocation into international indexes? Well, because, again, if we are trying to diversify, then what we can do is we can add international stock allocation in order to decrease the correlation of our returns with the stocks that we hold or the funds that we hold, and end up having a little less firm-specific risk, and have more of our risk spread out over the world than just having our risk in one particular country, even if that country is the U.S. and has provided us good returns over a long period of time, right? So having some type of geographical lines over which we diversify can be very important, and is something that we can do. And we should know that there are stocks that the companies, they are domiciled in the United States, and then some that are not, and we can buy funds along those same lines as well. Okay, so there's geographical lines that we can look at. Common stocks, there's different types of stocks, domestic and international. Then there are also stocks that, if we want to look at different ways in which we can diversify, different types of stocks, and these types are actually based on the fundamentals of the firm and the movement of the firm's stock, right? Exactly what it has done. And it's more of a subjective line, right? But this is the line between growth and value, right? There are growth stocks and there are value stocks. Now, this distinguishes between these two popular investment methods, right? Growth investing and value investing. Growth investors tend to look for companies that are seeing their sales and profits rise quickly. Value investors look for companies whose shares are inexpensive, whether relative to their peers or to their own past stock price. Okay, so growth stocks tend to have higher risk levels, but the potential returns can be extremely attractive. Successful growth stocks have businesses that tap into strong and rising demand among customers, especially in connection with longer-term trends throughout society that support the use of their products and services. Competition can be fierce, though, and if rivals disrupt a growth stock's business, it can fall from favor quickly. Sometimes even just a growth slowdown is enough to send prices sharply lower, as investors fear that long-term growth potential is waning. All those things are true about growth stocks, right? Ultimately, growth stocks are trying to take advantage of trends. They're trying to take advantage of what is going on in the economy right now and trying to grow quickly and trying to take a lot of market share. But very small things can impact growth stocks negatively in a very sharp way, right? Because these stocks do have very high valuations, and they really tend to base their valuation on what is going to happen in the future. And lo and behold, we don't know what is going to happen in the future. And if there's very bright things for this particular company in the future, and something kind of steps on that theory, steps on that hypothesis about the stock, then the stock can fall from grace very, very quickly. Okay, but growth stocks can provide you some of the best returns out there, and typically have done so, but they have not historically been the stocks that outperform. Historically, the stocks that outperform are the value stocks. Now, these are seen as more conservative investments, right? But ultimately, they are lower valuation stocks. Now, growth and value really falls into valuation. It falls into, you look at valuation metrics and you say, price to sales, price to earnings, how high is the price relative to the fundamentals of the firm? And value stocks are going to be cheap, right? These are often mature, though, and well-known companies that have already grown into industry leaders and therefore don't have as much room left to expand further. Yet with reliable business models, they've stood the test of time, and they can be good choices for those seeking more price stability while still getting some of the positives of exposure to stocks. Now, I think this can be where we look at this blurry line between growth and value, right? Because at what point does a growth stock become a value stock, right? At what point do we know that a firm has valuation metrics that are like value companies and not like a growth company, right? It's very hard to distinguish. It's very hard to note when this change occurs. But ultimately, all you need to know is that growth stocks are just that. They're trying to grow quickly. They're expensive relative to their fundamentals. Value stocks are cheap relative to their fundamentals because they are more mature, and there's less future to look forward to relative to the growth stocks, or at least the market perceives there to be less future to look forward to. Now, all three of these things I've talked about so far: the size, the place where the company is located, is headquartered, and then growth versus value. These are all really, really great ways that we can diversify. You can find mutual funds that track all these different areas of your investing life. You can buy growth stock mutual funds. You can buy value stock mutual funds. You can buy U.S. stock funds. You can buy international stock funds. You can buy large cap, mid cap, small cap companies, and large cap, mid cap, small cap funds, right? So you can diversify yourself in all of these ways. It is actually very, very cheap and very, very simple to do so with any reputable company that sells mutual funds, right? Or sells ETFs or whatever type of fund that you are willing to use, right? So ultimately, those are really good ways to diversify. Those different types of stocks are really great ways to diversify if you hold some of all of them. A hole in any of those places, though, let's say you hold all growth stocks, even though they may be domestic and international and of differing sizes, right? There's going to be more volatility to your portfolio and more ability for you to take some very sharp losses. But let's say it's all value. Well, maybe the prices will be more stable, but you won't make as good of returns. Or let's say you hold all domestic stocks. Again, you may have the volatility taken care of in certain ways, but if something happens in the U.S., then you're going to feel the full brunt of that versus if you had some international allocation. And then let's say you hold all small cap stocks, there's going to be more volatility and you're going to have less stability of price, and you won't have as much in dividends, and but you might expect higher returns over time when it comes to a diversified group of companies. So all these things need to be taken into account, but ultimately you can diversify very heavily along those lines and have all of your bases covered for the most part. Now, what other types of stocks are there, right? I said those can all help you diversify, but some of these other ones can too. These are just a little different, right? And ultimately, yes, there is a whole lot of overlap, right? Just because a company is a growth company or a value company, it can be a large cap growth company or a mid cap growth or small cap growth or value of any of those sizes, right? And it can be an international company that's a growth stock that is large cap or whatever, right? All of these things, there is a ton of overlap. It's not all mutually exclusive. So if you own a large cap index and you own a growth stock index, right, then you're likely to have a whole lot of overlap in what you hold. Or if you hold a value stock index and let's say a domestic index like the S&P 500, there's likely to be a whole lot of overlap in those two indexes. That's just the case, and you have to understand what that looks like and not over-diversify yourself in your portfolios, okay? So what are some other types of stocks that are out there? Well, There are also IPO stocks. Now, we don't really call them this very often, right? But these are stocks of companies that have recently gone public through the IPO process or the initial public offering, right? IPOs generate a lot of excitement among investors looking to get in at the ground floor of a promising business concept, but they can also be volatile, especially when there's disagreement within the investment community about their prospects for growth and profit. A stock generally retains its status as an IPO stock for at least a year and for as long as 2 to 4 years after it becomes public, right? So an IPO stock just is a really good chance to get in early in some cases, but it can also be a good chance to lose money because there are a lot of companies that go public in order to get some type of valuation that is not warranted, and then they don't perform as well as advertised after their IPO. But that is another type of stock that you could buy, a stock that just went public. Then there are dividend stocks and non-dividend stocks. Okay, so many stocks make dividend payments to their shareholders. Now, all a dividend payment is, if you do not know, right, is just income, right? It's just money that is paid to shareholders just for owning a particular stock, right? And this provides valuable income, and it makes these types of stocks very sought after in certain investment circles. There are people who are just heavy dividend investors, right? Technically, even paying 1 cent per share qualifies a company as a dividend stock. They can pay as little as that, and that is a payment to shareholders, right? Now, a stock does not have to pay dividends, right? This is something that a company chooses to do with their capital to return it to shareholders, to keep shareholders happy. And typically they do so when they have less in the way of long-term growth opportunities. Because typically companies that can still grow are reinvesting into themselves with their cash in order to keep growing, right? But if you have a bunch of excess cash and not a lot of things to do with it, then you may initiate a dividend to return some of that capital to shareholders, right? But again, a lot of stocks do not pay dividends. Now, non-dividend stocks can still be strong investments if their prices rise over time, right? And I would suggest that a lot of non-dividend stocks are the ones that do rise a lot over time in value. Dividend stocks tend to be a little more, stable in price, right? Have a little more price stability because they do pay you that income. But the non-dividend stocks, they tend to have a lot of volatility associated with them because those companies are still trying to grow and continue to reinvest in themselves. Now, there are stable companies that do not pay dividends, right? I can give you many an example, but one that just comes to mind is Berkshire Hathaway, right? But that's not to say that they don't return capital to shareholders. They just do so in a more tax-efficient way through share repurchases, right? They repurchase shares from the market, which increases the price and doesn't create a taxable event for shareholders, right? So even though they don't pay dividends, they are still a relatively stable company. And then there are also companies that grow very fast or have grown very fast in the recent past and do pay a dividend. Like Apple, it took Apple a long time to get to this point, but they do pay a dividend now, and yet their stock returns have been fantastic, right? They've provided high returns. But a lot of companies, again, don't pay dividends. Tesla doesn't, Amazon doesn't. A lot of companies that you could think of just do not pay dividends. And some of them tend to be those high growth companies that a lot of people like to invest in. So dividends, something that you can partake in or not. But again, you don't have any say. You don't have any say into whether or not you get a dividend or you get this, stable cash flow from a company. That is their choice, and they can choose to increase it, decrease it, create it, cut it at any particular time. That is up to the discretion of the company. Now, investors are going to react different to different decisions, but that is to the discretion of the company. Then there are income stocks. Now, these again are another name for dividend stocks, as income that is paid by a stock typically comes from dividends. However, income stocks also refer to shares of company that have more mature business models and have relatively fewer long-term opportunities for growth. This is ideal for a conservative investor. So basically, just another word for a dividend stock is an income stock, because they can provide you a lot of income That's why a lot of dividend stocks are used in retirement portfolios, because you can get upside of the stock, but you can also get some stability in the cash flow and the income that it provides. Then there are cyclical and non-cyclical stocks. Okay. Now, national economies, they tend to follow cycles of expansion and contraction with periods of prosperity and recession. Certain businesses have greater exposure to broad business cycles, and investors therefore refer to them as cyclical stocks. Cyclical stocks include shares of companies in industries like manufacturing, travel, luxury goods, right? Because an economic downturn can take away customers' ability to make major purchases quickly. When economies are strong, however, a rush of demand can make these companies rebound sharply. But by contrast, non-cyclical stocks, also known as secular or defensive stocks, you hear that word defensive quite a bit, don't have those big swings in demand. An example would be a grocery store chain, right? Because no matter how good or bad the economy is, you're going to go to the grocery store, right? Non-cyclical stocks tend to perform better during market downturns, while cyclicals often outperform during strong bull markets, okay? So you can kind of play this cyclical and non-cyclical thing by having companies that do well when the market tends to do well, or companies that just are very stable and do pretty well all of the time, right? That's the whole idea of the defensive stock, is that it'll do well regardless of what the macro outlook is, whereas the cyclical stock is only going to do well when the economy as a whole is doing well, and it'll kind of flow in that same way. And now, what's another type of stock, right? Another type of stock would be a safe stock, and you're like, oh, that's the stock that I'm interested in. I'm interested in those that are safe, right? Those that I can trust. Well, all stocks have risk, right? But safe stocks are stocks whose share prices make relatively small movements up and down compared with the overall market, right? So these would be not necessarily safe companies, but less volatile stocks. And the reason that stocks would be less volatile is that their cash flows, the cash flows of the underlying company, is less volatile, right? So it is safer. These are also known as low volatility stocks. Safe stocks typically operate in industries that aren't as sensitive to changing economic conditions. They often pay dividends as well, and that income can offset falling share prices during tough times. Right, so this can provide you with some safety in your portfolio, right, and provide you with some income. But you have to understand, safer stocks are going to, all else equal, provide lower returns, right? Because in investing, we know this, there is a risk-return relationship, right? The more risk you take, all else equal, the greater returns you should make. So safe stocks will ultimately provide lower returns than growth stocks or volatile stocks or whatever we're talking about, right? So that's another type of stock as well. Then on top of that, there are these different sector stocks, right? I'm not going to go through all the different types of sectors, but these are just companies in different industries. This is another way that we could go about diversifying. There are ESG stocks, right? And these are stocks or companies that really put a lot of thought into environmental, social, and governance concerns. Now, the scores that they give these companies are not always the most accurate, and also just may take into account a larger company's ability to spend money on these things relative to a smaller company. But you can invest in that way, and there are stocks that do that better than others, companies that do that better than others. And then the last little group or little dichotomy I want to look at here are blue chip stocks and penny stocks. Now, there are a lot of stocks that fall in between blue chips and pennies, but these kind of fall at both ends of the spectrum, right? These are based on perceived quality, right? Blue chip stocks tend to be the cream of the crop in the business world, right? These are companies that lead their respective industries and have gained strong reputations. They typically don't provide the absolute highest return, but their stability makes them favorites among investors with lower tolerance for risk, right? So we can all think of some of these big companies that are this way. By contrast, penny stocks are low-quality companies whose stock prices are extremely inexpensive, typically less than $1 per share. With dangerously speculative business models, penny stocks are prone to schemes that can drain your entire investment, right? So here we're comparing the blue chips where there's not a whole lot of risk and you can get some good returns over time, with penny stocks where there is a ton of risk, but I would say most people don't need to dabble in penny stocks unless it's speculatively, right? But blue chip stocks can be great investments over time for us to put our money. But again, there are other places that we may want to diversify our money out, not just in some of these blue chip companies, okay? So ultimately, those are the different types of stock. I know this episode was very educational and not so much my opinion or anything that is interesting as far as facts go, but you can learn a lot about different types of stocks, and you can learn a lot about the diversification process. And hopefully this episode is something that can help you and can be a good resource for you in picking the type of stocks that fit your risk tolerance best and fit the type of investing life that you want to live. Regardless of if you pick individual stocks or buy funds, I think you can find something useful in this episode if you are just learning about the stock world and just becoming more well-versed in the different types of investments that you can take part in. And I want you to be well versed in that. That way we can make good investment decisions and build wealth over the long term. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning in to this episode of Money's No Object. I'm your host, Dylan Howell. God bless.